All right, so today's video is going to be about the differences between short-term trading and long-term investing. So over the course of the past 2 years, I've really began focusing on saving money in a side account or retirement account. Shouts out to Ben forcing me to do these automatic deposits. Very important. Do automatic deposits to your brokerage or your long-term retirement accounts so that you don't have to see it, and it'll grow as you get every paycheck, so on and so forth. It's unbelievable. So over the past 2 years, I've been growing that retirement account. For me personally, it's a SEP IRA because I'm self-employed. I don't have a 401k. I have no employer contributions or any of that nonsense. I just have to do it all on my own. So the way a SEP works, or a Simplified Employee Pension Plan, that's why we call it a SEP, it's for small business owners and the self-employed, such as myself. So all contributions are tax deferred, meaning you don't have to pay tax on them right now. And all contributions are subtracted from your adjusted gross income. So let's say you make $250K in a year, you contribute that $50K. Instead of getting taxed on the $250K, you're going to be now taxed on the $200K. So you're lowering your tax liability in a huge way while still keeping a great portion of your money to invest for the long term. So the self-employed can contribute up to $56,000 or 20% of their annual income, whichever fits the mold there. All right, boring shit out of the way. So now I have two accounts. I have my active account. And now in this account, I'm going to be aggressive. This is the account that you hear me talk about 95% of the time. This is my trading account. This is the one I'm going after stocks from a technical perspective. So in my active account, I'm going for 100% return every single year. I'm trying to compound that account by myself. In doing so, I have to know that the P&L swings and the volatility that my account will experience is going to be much more dramatic than someone who is going for a 20% return, for example. That is the nature of the beast if you're going for these returns. So, knowing that I'm going for these aggressive returns in the active account, I'm going to mostly focus on the high beta names. Now, obviously, I have to do what the market tells me and go where the relative strength lies. But in a market environment like this where we're seeing a lot of things go, I'm going to mostly focus on tech names. Lately, it's been the software names, the Shopifys of the world, the Twilios. My time frame in these trades is going to be minuscule compared to my long-term account. I'm going to stay in these names 3, 5, 7 days, however long they want to break out and give me the move. But I'm really in and out of these moves, in and out of these stocks in this account. Now, in my long-term account, I'm going to be going after pretty much two different things. Now, the first thing is names that I use every day that also have a nice little dividend. The perfect example is Verizon. I'm a Verizon customer. I think what they're doing in the 5G space will have them be a market leader for the next 10 years. So I'm probably going to be their customer in the next 10 years. It's only right I invest in their stock. And since they have a 4.1% dividend yield, it's only giving me income every year. So for this type of trade where I don't care if Verizon's at 50, 55, or 60, I'm going to be in it. I'm going to continue to buy it on dips and hold for the long term. This is a name I believe in. I am not having any stops for these trades. The second type of name I'm going to look for is a company I believe in. But since a lot of times these are higher beta stocks that can have these dramatic swings, I'm going to have to use a stop of some sort. It's going to be a very wide stop. Whereas in my active account, I'm all about tight stops, the closest support level. But in the long-term account, I want to give these stocks room in case they want to run. The perfect example right now is Disney. Disney only has about a 1 or 2% dividend yield. It's not great. It's something that's nice, but I believe what they're doing with the streaming and all the parks that are opening and all these different streams of income they're working on that are just expanding like crazy. So I think they're going to be a market leader for the next 20 years, as they have been the last 20 years. So that's the company I'm investing in. I'm continuously buying these names. I'm just buying more and more and more over time. I'm rarely looking to sell anything of these names. So now the main difference between me and most likely you in how you approach your accounts, if you have that ability, let's say, is you should do it the complete opposite way that I do it. So because I'm a professional trader, I have no choice but to pay the short-term taxes that come with my short-term trading. But for you, if trading is something you do more on the side, then you're going to be in this game forever anyway, right? So why not trade aggressively in your long-term account so you're not liable for those taxes, and then keep your long-term holdings in your local brokerage account, your shorter-term one, and just hold on to those stocks. So you're doing all you can to lessen your tax liability. So for me, it's a cost of doing business. There's nothing I can do. I'm going to be transferring money in and out of this account, so I can't really have that luxury of avoiding those taxes with that little trick. It's nothing illegal. It's just something that people don't really realize. But for me, as I said, it's cost of doing business. I can't avoid it, but you should. All right, so let's get into more of the specifics of what I mean and how I'm going to trade these accounts. So this Verizon that I said, I don't care if it's at 60, 55, 50. I'm just going to keep buying this. And so for now, with the market at highs, I'll look at the NASDAQ real quick, see it all the way at highs here. I'm leaving the deposits in my long-term account. I said I make those bi-weekly deposits. I'm not using them right now. I'm letting them stack up because I'm so active in my active account. We see let's say, like the Shopifys of the world. These names, these are the ones I'm focusing on. Or I mentioned Twilio earlier. This had a nice little run this week, and MDB is another one, and Team, and so I'm going to trade these stocks in my active account, my short-term account. I'm trying to catch these moves, and I'm not really worried about the long haul of this. I'm going to keep really tight stops. This Team was trade of the week. I didn't have it, but here's the trade through 124, stop here, 122, and you kind of catch this move to 138. And that's really what I'm trying to achieve in my short-term account. I'm going to have a huge position. I'm going to take it off into strength pretty quickly. They say hold your winners, but in this account, I don't want to have to deal with the crazy gyrations because I'm going to have huge size. So now in something like Disney, I believe in this for the long term. I don't have a stop in for this. I'm buying dips. I haven't bought some in a little bit because it's just been running, but I'm every transaction I make is a buy. I'm not looking to sell this one. I'm trying to accumulate huge amounts of stock in these positions that I believe in over the long term. So the other style of trade that I will take in my long-term account is going to be a massive technical long-term pattern. A perfect example is this EA, which was trade of the week through this 99 area. And you can see it's just grinding higher. It's now at 113, and it looks good for the long term. So the advantages of doing that is that if I try to do that in my active account with huge size, I'm most likely going to be shaken out with the wrong stop. For me personally, I'm just not going to capitalize on that move in my active account because I trade that pretty short term. Another one is this PPG from last earnings. I still have this one. We can see this broke a massive long-term macro resistance level. I did trade this in my active account, but it's something I'm still holding in my long-term account because this is something that's likely to make a move over the next year or two. It's not going to be a fast mover. It's going to be a slow grinder. And then something I recently bought was this UNP. This is a beautiful long-term technical pattern, nice little flag here, and it's just starting to break through it. So this trade should take months to develop. I understand that, and I understand that if I'm in my active account, I'm likely not going to capture the move. The only way I'm going to do that is if I'm not staring at the stock every day and I'm not staring at my stops and trying to move it up as quickly as possible, things like that. So for the long-term account, the only technical trades I take are big macro bases, big macro resistance levels, stocks breaking out to new territories that they haven't seen in months, years. But other than that, these are the only types of technical patterns that I will buy in my long-term account. All right, so I know I kept it pretty brief today. I was just trying to keep it content heavy. If I missed anything, if you have any more questions about anything, just shoot down in the comments. We'll get to them. We'll straighten everything out. All right, hope you enjoyed it. Hope you learned something.